This computer. All right, everyone. My name is Sheen Trades. For those who don't know, I am a co-founder of TraderLink. And to get started, what today's class is about, also, happy early holidays. That's why we're kind of running it. And I'm running it for the only for the first 2 weeks. And the reason is because I'm leaving on the 18th to go on my vacation back to the homeland. But other than that, we have 2 weeks, 4 classes with each other. Just going over some basic things today. So to start off, we will be talking about GEX or gamma exposure basics. So what is net gamma? What happens when it's positive? What happens when it's negative? What is the AOI? What can the AOI represent? How to use gamma exposure for support and resistance, and how to identify potential chop. And then we're going to end off with a trade recap. And from Friday, I had a live with a couple of friends, and we caught a 150% trade using gamma exposure. And so we're just going to go over that, and then we'll finish off with a short Q&A. So starting off, what is net gamma? So getting into this, right? Net gamma is just this number right here. That's what's important, and that's what we kind of watch out for on a daily basis, just to get a sort of bias. Usually we like to look for plus or minus 3 billion. Sorry, I don't like that sound. There's a sound playing in the background. But anyway, but usually we like to look for plus or minus 3 billion. The only reason we like to look for plus or minus 3 billion is for the sole fact that it's just easier to, you don't flip back and forth, right? You don't want to be flipping back and forth in different environments. And the specific reason for those environment flips is it changes the hedging requirement if you're in a positive or negative environment. So that's kind of why we like to make sure that, okay, we came to the consensus that, plus or minus 3 billion, you're less likely to flip. And that's sort of like the minimum that we like to be at. Other than that, that's kind of like the most important thing for net gamma in terms of what we look for. 1 second, I need to send something to someone. But yeah, so that's what we mainly watch for. So long as we're plus 3 billion, or in a positive environment, in a negative environment for minus 3 billion, that's kind of what we pay closer attention to. So when you are in a positive environment, the pure basics of the price action that's kind of going, that you'll kind of see, this isn't obviously going to happen every time, but usually when we look at those types of things, we always, the one thing that we mainly watch for in a positive environment, or the kind of price action that typically happens, is essentially, obviously you have rips and you have dips, and what happens is they sell the rips and they buy up the dips. And when they do that, it's essentially dampening the volatility and creating extra liquidity within the market. So, and vice versa for negative environments. So usually on a negative day, that's why on, really big red days or overall red days, what happens is you have bigger price swings because they're buying the rips, and then they're selling the dips even more so. So that's the important part of positive or negative. Once again, to reiterate, we also save questions for the end. That's when we'll have time for the Q&A, where I can just answer them all, one by one. So write them down as you're listening to me. That's just makes things a lot easier and things more flowy. But yeah, so going for plus or minus 3 billion, and positive is volatility dampened and liquidity, more liquidity created. Negative is higher volatility, lower liquidity, and bigger price swings. So the next one on the agenda is, what is the AOI? For those who are, relatively new to looking at TraderLink and looking at the exposures in general, for gamma exposure, the AOI is what we've labeled as the highest exposure on the net chart. That's just something, so we didn't have to keep saying like, oh, the highest exposure, the highest exposure. It's just easier to label it the AOI. AOI stands for area of interest. It's just like I said, the highest exposure on the net gamma chart. So what am I drawing? Okay, here we go. So AOI in this case would be 45.25. And this is raw, this is skew adjusted, this is delta adjusted. But AOI is the highest exposure on the net. So getting into the next thing is, what can AOI represent? AOI or the highest exposure, what happens at it's essentially, we call it the area of interest, right? And the reason for that specifically is just because that's the area in which you'll see some form of activity happen. Whether when we get all the way down to the AOI, we get all the way up to the AOI, what happens is you will see some reaction of the market because guess what? The deltas are changing constantly. So dealers have to adjust their positions accordingly. So that's just kind of how we base it off of. The and we'll get into once again a little bit of a strategy afterwards of how to view the chart, because obviously when you see this, it's kind of confusing, right? Okay, look, there's a giant one at 45.60. There's another one here at 45.25. What am I actually supposed to be paying attention to, right? So what Gex essentially does is getting into talking about like playing patiently and waiting for the trade to come to you, right? Identifying chop. That's the other part that's important, right? So how to identify chop. So usually what happens is for how to identify chop, the easiest way is if you have multiple AOIs, multiple high exposure areas in which and that can essentially define the range for the day. That's the coolest part about Gamma is like, how back then, especially me, I'm always going back looking at, okay, maybe this data is a little bit different. It's harder. You're always making a nightly watch list and whatnot. And it's not always going to play out exactly the way you want with a watch list, obviously. But with Gamma and SPX, you can kind of see the defined range for the day. Let's say you have a high exposure at 45.50 and high exposure at 45.70, 45.75. Then that's kind of your defined range for today. And you'll see these types of days a lot and very often. And those are the type of days where you probably the best choice is to just wait for it to go to one of the top of the range or the bottom of the range and play there. Oftentimes, the way to look for potential breaks of the range is if you get to that point of, let's say you have exposures at 45.75 and 45.50. Let's say you get to 45.75. What you want to see is some sort of gamma exposure pick up above that. Then okay, maybe if we break 75, then we can go to the next level, right? That's essentially how you can utilize range breaks. But if you see just 45.75, 45.50, you hit 45.75, likely, and there's no pickup above it, easiest way is to go short there and play the odds like that. Not many people are reversal traders. However, this is one great thing about it is like you have the defined range for today. So if there's no pickup above 75, then guess what? You can go short at 75. That's kind of, and play your probability that way. Stops above, 75 or, size for zero. And we'll get into, once again, a trade recap for that, just because it's good to see what it looks like and how it can be executed. But yeah, going into, what was the next one? Okay, how to use gamma exposure as support and resistance. Basically, if there is positive exposure if there's positive or negative exposure above spot price, and spot price is obviously defined by this gray line, and this will move obviously with where SPX is. If there's positive or negative exposure above spot price, that can be used as support and resist, or that can be used as your resistance for above spot price. And if there's positive or negative below spot price, then that can be used as your support and resist as your support. And that's the easiest way to find a way to implement gamma exposure into your day-to-day trading, right? You have your own strategy, you have everything that you already do on a daily basis, right? Finding a way to implement this is just, okay, defined range, this will probably act like support, this will probably act like resistance. So like I said, this class is just a way for people to understand the very basics of gamma and how I can utilize it in a trade the next day, right? Because that's what's important. It's like, what's the point in, utilizing all this data if you don't even know how to read the very basic. So that's sort of how I would go about it. So something like this per se, let's look at 45.50, for example. Yeah, so if there is positive or negative exposure above spot price, and I'm not talking about like small exposure, I want something bigger, like something like this. Let's just take this as an example, right? Okay, let's say we get to, this is what I see as chop, but this is skew adjusted. So skew adjusted will take into account a lot more areas. If you want my personal opinion, I think raw and de-adjusted are the ones to focus more on. Delta adjusted takes out a lot of the noise and kind of gives you the place in which the stock or SPX specifically will have more of a reaction to, because it takes into account a lot more things than just regular raw gamma. However, raw, if you know how to play with it, if you know how to read it, then that's personally my go-to. I kind of stick to raw and delta adjusted. Like I said, those are the two I mainly watch. I just have this on skew adjusted on here just in case if I see anything, but I don't pay too much attention to skew adjusted as much as I do raw and delta adjusted. But this to me signifies chop. Obviously, this is after hours, so the data is a little bit wonky. And by the morning, by the first like 10, 15 minutes, it'll clear up and you'll see some form of direction. And unless, it stays the same, then you're more likely to see chop that day. But continuing forward, what was the next thing on the agenda? Sorry. Okay, yeah, support and resistance. We've done that. How to identify chop. We've done that. Multiple AOIs, multiple exposure or high exposures at different areas. And yeah, so let's get into a trade recap because I feel like that's very important. That's where you get to see like, okay, how does a founder utilize this data, right? Just strictly off of price action and gamma exposure for this trade, because once again, we're only talking about gamma exposure today. So getting into it, I took the liberty of taking some screenshots for everyone and basing it off Friday's trade. Today, I can give you guys today's trade. It was an L, but that's just because things change. It was a good idea and it worked out pretty decently for the time being. However, obviously didn't net a very good return. Contract selection was too far out the money, and split divergence kind of disappeared. So, but we can get into that as well. But getting into Friday's trade, what did we see on Friday and why did we take the trade on Friday? Obviously, Friday we had Powell talking. So there's two big things. Green arrows, I was in calls. Green arrows represent entries and red arrows represent the exits. So this trade was about 150%. I have okay, so let me pull up let me copy this so I can put this here. So this was my trade execution. Just make it a little bigger, obviously, so you guys can see that I'm not lying about when I entered and whatnot. So runners hit about 150%. I think most of the trades were taken off around 30 to 50%. And runners were just left for 150%. But yeah, so this is the data at 725. This is where I took majority of the size as well as right here. So data didn't really change going into this point. This is 802. So I was right here. But yeah, so I bought initially at 715, right? The six, for those who don't know, I do a lot of meme entries being 6.9 and 420, just because I think it's funny, but that's really about it. All right, now I know WD in the chat is Alejandro because he's calling me out for paper handing, but it was a perfect exit for the time. So shut up. Anyway, yeah, as you can tell, obviously these closed at 18.7 for this, or latest trim was 9.5. But anyway, beside the point. So I took entry at 715 right here, which is once again, so the thing that I noticed here, let's make this bigger so we can see it, right? This one right here was really important to pay close attention to. The reason why I was watching it and why I took entry was because there was a bar here. Once again, right? Positive or negative exposure above or below spot price can act as support or resistance. So this was sitting here at 45.60. So obviously I marked 45.60, as you can tell right here, as a gamma floor, right? That'll act like the support. And I marked 75 right here as a gamma wall, which was this one right here. So 60, 65, 70, 75 right here on this big blue bar. So 75, obviously, and this is what I was talking about when you see exposure above, then you can see, okay, if we go above 75, we can go to the next level, right? So that's essentially how you can go about it. But this is a really good example of how to utilize it, how to trim, how to take entry, how to see if we can go further and whatnot. But so yeah, I took entry here at 715 for 5 contracts, added 5 more here. So once again, that was quarter size. I wanted to be in 20 contracts, quarter size right here, another quarter size right here at 5.0 from 6.9. So obviously there's a big drawdown, but once again, you know your risk, quarter size initial, add another quarter size, full size by the next time. So entry here was at 6.9, entry here at 5.0, another 10 contracts here at 3.75. The thing that I was watching for and why I took these add-ins is once again at the 60 level is the gamma floor, right? This was the floor for the day, as you can tell right here. And that's pretty much what I was watching for. And that's why I took the entry right at 60. And yeah, trims were at 75 once again. So 803 trimmed here to take off majority of the risk. Not 75, obviously, but took off majority of the risk, right? At 30%, 40%. And then right here, maximum trim, maximum exit at 75. It's very simple. There's not much going into like the breakdown of it, but it's very simple. Like I said, just to show you guys exactly how you can utilize it in a very simplistic manner. I mean, that's pretty much it for this trade recap. And obviously right here, right? Talk about going into a bigger extension move, right? As I said, okay, we have a gamma wall at 75, we hit a trim. And obviously, as I said earlier, if you see pickup above it, what can you do? Maybe once we break above 75, we'll go to the next level, right? That's exactly what happened. We broke above 75, came and retraced, and then this stayed. I can even show you guys what it looked like at 823 just based off of our Discord screenshots. It'll show the same. But that's what I'm talking about is like, okay, this exposure is huge, right? Above this wall right here. So the likelihood that we go to there, very high. And obviously 45.95 gamma wall hit, right? So once again, that is the simplest way is okay, find an area where you can take an entry at a support, whether that's negative exposure or positive exposure below spot, and then mix it with price action, right? Why aren't you paying attention to the big? Because they're not big enough in the sense compared to, also we're in a very positive exposure. So I think the basis of it is like, okay, if there's more positive, then yes, we're going to look into, going long. If there's more exposure above spot price, then we're going to go looking for longs. Right. Unless once again, 95 was still a great short. If you entered at 95 right here, yeah, you would have had a drawdown, but still would have had a good trade. 95 down to what, 85? That's a 10-point trade. I'm sure contracts, depending on which ones you picked, right? Contract selection is very important. If you want to know how I pick contracts, usually I like contracts that go $5 to $10 in the money. That's usually how I go about picking my contracts. Like, let's say there's 75 here. I was in what calls were I? Was I? Okay, I was in 75 calls. Actually, for those who were there on live with me that one time, the friends that I was trading with, I was looking for 4,600. I hope Rumple's not here, but Fatty is and Jay Crispin is. I said the day before I said 4,600, so I was targeting 4,600, but oddly enough, yes, paper handed. Where do you get gamma wall, gamma floor? Okay, so let me delete this. This screenshot right here, right? This was at 7:20. We'll call this 7:30 to 8 o'clock ish. That's what it looked like at the time. And that's what I was paying closer attention to. So you can see this is the 60 on the chart. There's a big positive exposure bar right here. So I took the entry at the 60. Once again, based it off of extra, a lot of PA as well. There's heavy resistance right here. As you can tell, we rejected 60, we chopped around 60. So 60 was going to be a decent area to take entries on in terms of longs. Yeah, exit once again was based off of this one right here. 75 wall. Could I have held? 100% could have held. Did I get a lot of shit for paper handing and not holding for 4,600? Yes, I did. That's beside the point. It's just that's where I exited because 75 was a good area. At the time, it was a perfect exit. 9.5. This drew down to 6 or like 5.5. But yeah, that's pretty much how you go about taking entries and exits and whatnot on utilizing gamma exposure. Okay, now it's the Q&A time. Hit me with it, guys. What would you have concluded if the PA had gone to 45.40 after your entry? What would you have concluded if the PA had gone to 45.40 after your entry? I mean, the trade would have been a lost trade, right? Would have just taken the L, sized for 0 on every trade. Come on, Phil. I know you know that by now. How do you interpret large gamma walls above and under spot in a negative environment with underlying moving? Okay, moving steadily up. What happened today? So Similar thing. I took the liberty of taking shorts at 65 to 70 area. I can get into it. I had this all drawn out earlier. So we can keep the 70, or we'll drop this to 70. 70. Okay. This to 65. This would be that short zone as you kind of go about it, right? Ignore gamma floor, gamma wall for now. That's just there for the labels, but in terms of where's the drawing tool? This one. This one. Need a rectangle. So this is essentially where I went short today. I went short around. I can pull up the timestamps. Let me check my timestamps today. And to preface, this was a red trade today. And I have the image of what I was watching. Let me put that up here. Copy, paste. Okay. This is what I was watching today. So even though we pushed up, what happens is, okay, we have the 65, we have the 70. So I draw that zone area, right? The next thing I was watching is there's this thing called split divergence in which we'd like to see, or we'd like to find if it is there, is that, as you can tell, 50 right here, this is 40, 45, 50. 50 doesn't show very much here, but as you can tell on split, there's a lot of open interest or open contracts in terms of positioning for dealers right here at the 50. So that's kind of what we pay attention to. If, yeah, we have a 2-bar setup where it's 65, 70, and obviously we ran up from there. And this is at 925. So right around here at 925, right? Let's get another marker. We'll use a horizontal line or vertical, sorry. Vertical line at 925 right here, right? So 65, 70 was the short area. You could have taken entry here. And I would have probably picked the 60 calls, or I mean 60 puts, sorry, because 65, once again, 5 to 10 points in the money. And then we would have targeted the split 50, right, which is down here. The thing that didn't play out as I would have liked it to is that as we pushed up, and I didn't pay attention because I was walking around doing errands around the house, but 50, the split divergence disappeared. Even when we were down here, the split divergence had disappeared. So that's when you can kind of take into account that, okay, when you're looking at this and you're targeting the 50 split divergence and it disappears, then you're likely not going to hit that anymore. You're probably going to draw back up to 65, 70. And look what happened. Obviously, we drew back up. Contracts where I had taken 45, 55 puts at 2.8, and they got back to 2.5 right around here. It had been a little bit, I picked them up way earlier, like around here. Like the 8:30-ish area, something like that, or 8:45. But yeah, that's kind of how it played out. The idea is good. What happened is the split didn't play out. It disappeared by the time, even when we were down here. So at that point, you can kind of be like, okay, this probably isn't going to go back to that split 50. But the concept of your entry was there, right? So 65 to 75 zone was going to be your entry. So you take shorts here. And even right here, if I look at this 710, I'll pull the screenshot for 710 just to see if that's the same thing that happened. SPX gamma 710. This is going to take me a few seconds. I got to scroll up. 11 1044 954 904 need 710 814 730 724 710. Copy image. All right, perfect. We'll see the same thing. This. Copy image. Take this. Okay. As you can tell, even at 710, right? Let's move over a little bit. We'll see. 710 split divergence, right? Same concept. Negative above spot, you take the short, and there's this 50 split was much bigger, much bigger, right? And we were also in a negative environment, meaning the move is going to be, once again, they're going to sell the rip. And if the dip comes back, they're going to buy, or if they're going to sell the dip, obviously it kept dipping and they're going to buy back the rip. So same exact shit happened today, right? Just the basic concepts will allow you to visualize price action a little bit better. Sorry, I know there's a lot of questions, but I just want to get this one over with. But yeah, as you can tell, 65 was going to be your short entry, came into the zone, boom. Even up here, you probably could have drawn the zone out more. Even here, if as you can tell, 65.70 is going to be your short zone, could have entered anywhere here and then held it all the way down to 50 today. It's the same thing. I wasn't awake at this time. I woke up at like 8:30. But yeah, that's how you kind of utilize entries, and then you can target those split divergences if they're there. They're not every day, but they are there. And when they are there, they can be a huge, huge way to, take advantage of a trade or take advantage of a move. Okay, so how do I interpret? There you go. JC, that answers that question. Why are you such a Chad? Thank you. I couldn't tell you. I wasn't, mom didn't raise a bitch, Is same gamma chart, but two different time frames. Huh? Sorry. Add to Caleb during the 7:38 o'clock screenshot. Isn't environment negative plus gamma bars below spot prices larger gamma bars below spot? So if you want to lead bullish conviction besides that 6. Yeah, you could lead a bullish. You could have longed it from 50, that split, all the way back up to 60 and 65.70. It's the same thing. There's obviously you can play it different ways. I wasn't awake at that time, so I was waiting for the 65.70 hit again and go short. So that's just me. So once again, if we hit that 50, that's not true. I was awake. I tried going long. I had my canceled orders. I tried to enter at 8:23 for the 55 call. 8:23 right here. 55 call. I was entering these. I tried entering 3 times over the span of that 8:23 time. Order didn't fill at 4.3. Order didn't fill at 4.6. Order didn't fill at 5.0. So that contract moved up during that push. So I was like, okay, if I had to cancel, replace my order 3 times, that's just a personal thing. I mean, that just means the trade wasn't for me. So Coke or Pepsi? Coke all day. Would you have considered a re-add something down there? Like, what would have salvaged the trade? And I think this still goes up. I don't think I would have added. I think the one thing I would have done, if let's say I still think it's salvageable, and that 50 was still there. Let's say we hit 40 and that 50 split was still there. I would have flipped to contracts. Probably I would have dumped those 55 puts or calls. Sorry. Wait, yeah. I would have dumped the 55 calls and then flipped to wait, no. Wait, I don't know what that was talking about. But anyways, if we're down at 40 and let's say it was still showing 65.70 negative, then I would have dumped, I would have exited puts, waited for, and we're down at 40, right? And I would have longed. And then obviously I'm assuming based off of my knowledge of it, I'm assuming 50s, that 50 split divergence would still be there. And then I would trim at 50, leave runners for 65.70. That's how I'd go about it. Or that's how I would save that one. How would your wall and floor marks change for the overall neg gamma? Still marking large bars. Yeah, I would always, for those who are newer to this, I will always suggest marking large bars. That is, and labeling them. If label your AOI on the day, and then if it changes, relabel a different AOI. But I would always suggest, like, people who are just getting into this. I know Willie's been in this for a while, but I always suggest labeling the AOI for the day. In the beginning, if divergence goes away, slap the red alert button. Yeah, exactly. If the divergence goes away, then that trade is likely gone. In terms of that target, how do you determine which is the AOI to pick if there are multiple big gamma bars on that are both? I would just not pick them. If I see 2 large bars that are very similar in terms of gamma amount, talking like this, right? You can just hover over it and see net gamma. Okay, that's 0.5, negative 0.567. This one is negative 0.63. If they're like, I wouldn't even bother, like something like this. Like, let's say we hit 50 tomorrow, which obviously I think we can hit 50. And then potentially even 40. Then if we break 50, likelihood of going to 25, let's say that 50, let's say you get below 50, you get to like 45, you get the 40 area again, and that 50 starts disappearing. It starts getting smaller and smaller and smaller, and that 25 starts getting larger and larger and larger. That's when I would suggest, like, okay, we're going to hit 25 then. 25 is the area that we're going to go. Thank you, Fatty, for answering questions. Fatty is also, for those who don't know, in the TraderLink chat or TraderLink Discord, Fatty is an admin. Same with Jason. So if you guys also have any questions, you guys can always ask them too as well. sorry if I missed another admin. Those are just people that I've seen in the chat. Can you repeat what you said about where you would go short because spot prices? Okay. So going short, I would have gone short around 65.70, right? This is just the zone for today. I would go short typically at bigger areas. You have to have a reason to go short, right? So if there's an AOI above spot and we finally make it to 70, let's say it's at 75 and we hit 75, and then there's still some sort of split divergence, or there's a bigger there's something similar, there's a defined range, there's another AOI or another exposure bar, not AOI. AOI is always going to be the highest. There's another exposure bar that has relatively the same size as the other one, as the actual AOI, then you can go short at, the one above spot price and then play it down to the other one. Obviously trim along the way, secure some profits. There's nothing ever wrong with that. And that's how you make money. But you go short at the AOI at 75, and let's say there's another big bar at 60, then you can play it down. Your ultimate price target will be 60 and obviously trim along the way down. I was talking about the frame. Alejandro, I hate you. Yeah, multiple AOIs equals choppy PA. For the gamma pool, can we just pull it from TOS option chain, or they're different? They're different from TraderLink. We have our own calculation. That's not exposure, I don't think. How do I know what a divergence is? Okay, so divergence is like this. I can draw it out, it'll be easier. Let's do the colors. So we have a red bar like this, right? So let's say this is the line in the sand. We'll do a blue line. This is the line in the sand, right? Now we go back to green. And then we have a bar like this, right? This is what split looks like. Pretend that's fully colored in. Pretend that's fully colored in. And then the line in the sand is, let's go to split now, right? Or let's go to net. So let's say you have a net one like this. And this is following the same thing, right? Let's say now you have a net like this. We go to like a cyan color to match, and it's like this. So a split divergence is essentially when you have the split bar look like this. Let's say this is 50 and the 51 on net looks like this. This is what you can call a split divergence, meaning there's a lot of contracts here that are in play. However, it doesn't show on net. That's why I have two. That's why I have two open, so I don't have to flip back and forth. I can just see it like that. Yeah, they cancel each other out. Keep in mind, the net chart is the same as the split. It's just mathed out. Like this one, 0.5 negative, we'll take this number here. This is 50 minus 0.567. Let me get a. Sorry, white screen, you guys. Flashbang. Okay, so let's take this number, which is negative 0.56. So 4550 net minus 0.56. Okay, now we take this one at 50. It is minus, so 4550 split red is minus 0.64 minus 0.64. And split green is 0.5. Oh, sorry. Split green is 0.07. 0.07. Oh my God, I'm hitting the wrong things. Equal sum, parenthesis, up arrow, these two, there we go. 0.57. Obviously, there's decimal places after, but that's just what it is right now because I'm using just the first two digits. But yeah, it's just mathed out. So that's how it is. Anyway. Okay, now I need the chat open again. Chat. Okay. We're trading to and or from shop price. Yeah, exactly. So you're kind of just trading. So the best way, like I said, to reiterate and go over things, the best way to utilize gamma exposure or the simplest way, not the best. The simplest way is to essentially make sure, sorry, the simplest and best way, in my opinion, is to use it as support and resistance, right? You wait for it to get to a certain exposure and take action there. That's it, because there's going to be something that happens there. How do you determine? Let's go down a bit. It's the net gain. Yeah, exactly. Net and split is just mathed out, like I said. Then count your tactical. Correct me if I'm wrong, but point behind split divergences. If net exposure seems smaller or not there, be careful. Look at split to confirm. Yeah, that's a good way to visualize it, Willie. How do you personally set stop losses? How far do you let price? I don't have stop. I'm size for zero every time. I'll let 10K, 15K, 20K go to zero. I could care less. Wherever the net gamma is, do we call them? I'm more upset. The only time I get upset is when the play doesn't pan out the way I want it to, as I had planned. If it, if actually that's not even true. I just don't get upset, win or lose. Can you elaborate on how you could incorporate the IV? So IV is a little bit different. It's different than it was previously. Previously, we had the cheat sheet. Now that the IV skew has changed, it's more in line with how IV should be visualized. And guys, for the old cheat sheet is, in my opinion, deemed useless now. The reason I say useless is because initially that was always a theoretical thing. So for those who weren't here in the beginning, Gio and I were always a lot of these strategies that we came up with in the beginning, those were just back tested by Gio and I. Those were just things that we came up with because that's just based off of what we saw, right? And understanding the hedging requirements. But now that the IV skew is a little different, it's the other cheat sheet is sort of you can almost say invalidated. We can try to theorize different strategies again. It's just been very busy lately. Okay, it seems like we answered most of the questions. Not all of them. Yeah, though, like I said, for those who aren't, well, you guys have to be in Discord. Just if you have any questions, feel free to always at me or Geo, people anyone with a red name or red name tag in Discord, also great people to ask questions to. They've looked at this as long as we have, since the very beginning. That's why they have that tag. We call them Apex traders because before we became TraderLink, Geo and I were called Apex Capital. So those were the people that we deemed were that you can get good information, and they helped us answer questions in chat and whatnot. Apex got the goats. Yeah, so that old cheat sheet, Farzo, for that's the old cheat sheet. So for those who watched like the masterclass, my section, which was day 4, that one is pretty much now invalidated, just because of the new IV curve and also the new calculations for the exposures. That's why we now have this way, which is just the simplest version, support, resistance, defined range for the day and whatnot. That's sort of the simplest way. And the you can also obviously use Apex AI, the price magnet is obviously in beta, but the thing is with the price magnet is, from my experience, it's great on a trending day, and it'll get you, like on a choppy day, it'll get you shorter targets. But even then, the Apex AI was never there to solely be the end all be all. It's always been, take that with a grain of salt. That can just be added conviction on top of what you already have as a strategy. That's how I use it. There's a whole video on it. I made a whole video with a trade example that I took for like 250% on a trending day. Fantastic. Lines up with your shit. Let's say the Apex AI gives you your long price target and you're already looking long, and you have a price target around that same area. Fantastic. Apex, I guarantee you Apex AI will hit on those types of days, right? But on choppy days, they're going to give you smaller trades. Like today's price target was 60 on SPX. If you look at 60 on and let me see 60, it hit, but it's like, does someone really, like right here as we were pushing up, it hit 60. right? You could have went long here, or you could have gone long when we hit 50 all the way to 60 and played the next levels up, which was 65, 70. Yeah, so like once again, just to reiterate, ranges is like if you have two big exposures on the chart, that's kind of like what will define a range. If you have only two exposures at, let's say, like 50 and 75, your range for the day is probably going to be 50 and 75. It's a 25-point range, give or take. Take longs at 50, take shorts at 75. That's pretty much all I can really suggest about those. All right, I think I've said enough, so I'm just going to stop the recording.